Today, instead of finding those rising stars on the market, we are looking for the low-hanging stocks. Fasten your seatbelts, folks. This is going to be a good one. We are going to look at the worst performers on the TSX in the last year as we, count down to the ultimate stinker. Along the way, we will also be paying homage to those companies we have lost along the way. With our In Memoriam, we will be looking back over the last 30 years to pay homage to the tickers that, the ones that once were but are no longer with us. So without any further ado, let's get this show on the road. Kicking off the top 10, we have that company I love to give grief to in the form of Rogers with a ticker of RCI.B. The telecommunications sector has struggled in the last year, and with all the added debt Rogers piled on to buy Shaw Communications, they were all but assured to make this list. If there is a silver lining for Rogers, rate cuts should overall improve their debt issues, at least a wee bit. They began 1 year ago at $66.95, and they're closing out at the time of recording at $57.01. So that is a total return, because we factored in the dividends as well, that's a total return of negative 11.86%. Sticking to that Canadian communication sector, we do have TELUS, ticker T, coming in at number 9. This is a company that has struggled with the rising interest rate, as their sector, it's very capital intensive. In addition to that, TELUS has faced challenges in its operational performance. Despite reporting growth in revenues and customer additions, the company has struggled with declining earnings per share. Also, the company's effort to expand its 5G network and improve its infrastructure have also required some pretty significant capital expenditure. That is, of course, adding to their financial burdens. TELUS is still not really showing signs of improvement, but I do still like them long term. Of course, a year ago, they were $27.54. Time of recording, they were $22.01. Add in those dividends, we get a total return of negative 14.86%. Target, a very well-known brand in the United States, made its move into Canada in 2013. But they failed miserably, and they were unable to make a profit. Not making a profit means they eventually filed for bankruptcy just 2 years later in 2015. Gosh, I sure am going to miss those big red balls they had in front of their store. Moving back into the countdown, we have a mining company taking our 8th spot. Franco-Nevada Corporation has a ticker of FNV. In the last year, this company's shareholders have not been happy, as their earnings per share and revenue growth have been missing expectations. Of course, if you add in those higher interest rates, we have a recipe for an epic fail, which they experienced well enough to get on this list. On the bright side, though, this company has been moving back up in the last few months, which is very good to see. Otherwise, they'd be a lot deeper on the list. 1 year ago, they opened at $210.67. They closed at the time of recording at $174.75. Factoring in the dividends, we get a total return of negative 16.40%. Taking our 7th spot as we count down the worst performers on the TSX in the last year, we have Algonquin Power and Utilities, ticker AQN. This is a company that really shook investor confidence when they cut their dividend back at the beginning of 2023. In addition to that, the last year was it was not very kind to utility companies in general. Of course, selling off some of their assets also ruffled a few feathers of their investors, so it hasn't been a great year for sure. The good news is that things are starting to look a little bit better for the sector, and with rate cuts coming, that will be an added push to help AQN get off this list. 1 year ago, they were coming in at $11.49. At the time of recording, $8.98. Factor in their dividends, we get a total return of negative 18.09%. When it comes to financial mismanagement, Zaybec Absorption Incorporated was one of the best at messing up their finances. This gas purification and filtration system company, they were on the cutting edge of innovation with a growing demand for clean energy. However, along came that pandemic, and they were not able to navigate the supply chain issues, which led to some much higher production costs. And, when you add in their operational inefficiencies, this company was primed to fail, and, they did, and they applied for bankruptcy in 2022. Moving back to the countdown, Number 6 is a surprising one for me, as it is a company I am very bullish on. We have OpenText, and a big part of their failure has been that shareholders have been facing some uncertainty in the light of OpenText selling their application modernization and connectivity business to Rocket Software. This was a move to center them more on cloud and AI opportunities, which I actually think is the right move, and it did provide some cash to help reduce their debt. Once they regain the investor confidence, they should get back on track to get off this list ASAP. They opened a year ago at $54.35. They have fallen all the way down to $41.86. Factor in the dividends, we do get a total return of negative 21.88%. Join today's conversation. Let me know in the comments your worst performer of the last year. Thank you for your participation. If you love this sort of content, be sure to subscribe for more, and another huge thank you for that click. Breaking into the top 5, we have hit the dairy sector with Sapato Incorporated. I guess when they are processing that milk, their cream did not rise to the top. Part of their problem has been a falling demand for milk products. As a result, they have had to revise their earnings forecasts and push back a lot of their target dates. And that can very negatively affect investor confidence, which is exactly what happened. High interest rates have not helped, and additional uncertainty has set in from the sale of 2 of their milk processing plants down in Wisconsin. The debt situation should improve with rate cuts, but they may have to move forward into a retail environment where people are choosing milk less. I had almond milk on my cereal this morning, so I might be part of the problem. They opened a year ago at $35.88, and they closed at $27.25. We get a total return once the dividends are factored in of negative 22%. The fall of Sears Canada was the end of an era. They were a staple in the Canadian retail landscape until it all came, crashing down. Their fall in 2017 can be seen as a failure to adapt to a changing retail environment. They failed to invest in the changes to keep Sears relevant as they faced a slew of increased competition at stores like Walmart. Instead, they watched their sales decline and debt rise until, the bankruptcy fairy decided to pay them a bit of a visit. I was not expecting to see one of Brookfield's companies on this list, but here we have it. Brookfield Infrastructure Corporation, BIPC the ticker, coming in at number 4. In the last year, they have experienced close to a 90% drop in earnings, which has unnerved many of their investors. They are also pretty bogged down with high debt, and servicing that has impacted their cash flow considerably. As bad as that all sounds, there is a silver lining here, and that is that Brookfield has been expanding their portfolio big time, and that does come with a lot of upfront costs, but they could be setting themselves up for some nice long-term growth. In the last year, their price opened at $62.99. It fell to $47.48. After we factor in the dividends, we get a total return of negative 22.16%. In our third spot, we have Tech Resources Limited, and let me tell you, they have had a challenging year for sure. First off, they have had operational issues that have led to lower than expected copper production, which of course has definitely impacted their financial performance. Inflation has also upped their cost to operate quite a bit. Add to that some volatile commodity prices coupled with market expectations of declining earnings, and you have a negative catalyst for their stock price. Additionally, there have been strategic uncertainties, which include the sale of a minority stake in one of their coal businesses, and some broader economic conditions have contributed to that decline as well. I do still like this company, and I think as commodity prices continue to rise, it will bode better for them in the next year. They did open the year at $98.32, and they closed it at $70.67. Total return after we add in the dividends of negative 23.04%. When it comes to Trevally Mining Corporation, this is one I will not make any jokes about because their failure has a tragic side to it. I can talk about the rising costs and financial strains the company had experienced, but one of the major blows this company experienced was a disaster at their Paroquia mine. In 2022, they had a tragic flooding that unfortunately took the lives of 8 workers and resulted in a situation that impacted production and the company's reputation. Between their overall lack of risk management and strategic planning, it was inevitable that they would close up shop, well, that same year. We are almost there, and this is a store I love, so I hate seeing them at number 2. Canadian Tire has had a rough year. They consistently reported disappointing financial results, with earnings per share significantly missing analysts' expectations. Their underperformance was coupled with softer consumer demand, leading to decreased sales across various segments, including a 7.6% drop in Sport Chek's retail sales. They have also been affected by higher funding costs and net impairment losses within their financial services segment, contributing to a decline in their overall gross margins. This is a tough one to predict in the next year. Rate cuts will help, but they need to see more customers in their stores or online to get that cash flowing back within expectations. 1 year ago, they were priced at $325.90 a share. At the time of recording, $240.01. So that is a total return after you factor in their dividends of negative 24.24%. Okay, we are going back for this one, but many of you recommended I talk about Nortel. They were at one point an absolute telecommunications giant in Canada. Many investors back in the day even considered them to be rather blue chip. But sometimes the mighty fall, and that indeed is what happened to Nortel. Nortel made some critical errors as the telecommunications sector was changing. They failed to adapt to the rapid technological advancement the sector was experiencing, and instead, they doubled down on traditional telecom infrastructure. This set them up to fail. Well, for sure. They had already been overexpanded in the 1990s thanks to that tech boom, and, well, they watched a lot of that come crashing down and turn into pure debt when the dot-com bubble burst. With that bubble bursting, they also began to experience a plummet in revenue as the losses just began to mount up. As they came to the realization that doubling down on the old traditional infrastructure was a huge mistake, this loss in revenue and huge debt load was preventing them from playing catch-up, and this was the beginning of their final swan song. In 2009, Nortel finally filed for bankruptcy. We are finally at the top spot, and let me tell you, this company won the dishonor by a mile. In fact, they almost did twice as bad as number 2. We are back into the mining sector, and at number 1, we have First Quantum Minerals. They have had a very rough time in the last year. Their Cobre Panama mine had experienced some operational and financial difficulties that resulted from lower than expected copper production. If this wasn't bad enough, they also had a dispute with the Panamanian government over royalties and environmental regulations that further complicated their operations and, in fact, led to a shutdown of their main mine. They have also been the victim of weaker nickel prices, which has really impacted their mining of nickel, as they have had to scale some of it back due to, well, higher operating costs. There's no point pulling something out of the ground at a loss. If they can resolve all of these downward issues, they could recover. But I would be hesitant to expect that to be the case anytime soon. This one is number 1 for a reason. 1 year ago, they had a share price of $32.17. At the time of recording, their share price coming in at $18.24. Their total return, even after we add in the dividends, comes in at negative 43.05%. Holy banana bread, that's pretty bad. These were some stinkers for sure. And despite that, many of them are not bad long-term investments, though there are some of them in there, and I'm sure you can tell which ones, that are much more riskier than others. If you are interested in any of these stinkers, still be sure to do a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this video on TD Bank, and I will see you in the next video.